But what I'm really passionate about and what I'm doing on the side, as Chris alluded to, was real estate investing. And so this is kind of my vehicle, my path that I am taking toward financial freedom, time freedom, all that fun stuff. And I see a light at the end of the next 12 months. That's my goal, and I see a path to it, and I'm really excited and passionate about it and pushing toward that. And then I also help other folks get started in real estate as well, whether that be through actively investing like I'm doing, or even passive investments, partnering on deals, syndications, those types of things.
Hello, everyone, and welcome to the Hands-On Logos podcast. This is where we discuss current events, personal growth, and any other random topic that crosses our minds. Our goal is to have a meaningful discussion that help us to see the topics we discuss more clearly. Our hope is we can help you expand your self-awareness, develop your critical thinking, and learn to be less reactive to the world around you. And most importantly, remember, be curious. If you like what you hear, like this video and subscribe to the channel. If you have any feedback, please leave a comment. We want to hear what you think. We appreciate you. Chris?
Yes.
Guess what day it is? Guess what day it is?
It is podcast Saturday.
Saturday, that's right. Friday, normally we do podcast, but we didn't do it Friday because I think, Chris, you had a challenging schedule, so it's Saturday morning. What's the date? 4/5/25 is the date.
Yep. My wife keeps telling me that I have to hit that button on submitting the taxes. They're done and ready to go, but I haven't hit the button yet. I always have to look at it a couple more times before I actually submit the button.
We are in tax season. I spent all day Wednesday preparing for taxes and then a little bit on Thursday. So it's off to the accountant. So hopefully I'll get some money back. That'll be
I'm a little upset with TurboTax because I went online and did TurboTax because I always do. But the online version is more expensive than if you buy it at like the software at Costco. And I didn't realize that. So I did the whole thing, and at the end, they tell you how much you owe for the software. And I'm like, dude, it's half the price if I just buy the software at Costco. So now I'm like, do I go buy the software and then re-enter the data or not?
I mean, you might be able to export it and re-enter it again or something.
Anyway, so Chris Jansen is our guest today, and I met him at a Chamber of Commerce meeting couple weeks ago, a month ago or so.
I think we got to talking Costa Mesa Chamber of Commerce.
Costa Mesa Chamber of Commerce, yeah. And we were talking about real estate, since that's his specialty or his focus, and I thought we'd invite him on and talk about that. So, Chris, give us a rundown of who you are and what you do.
Awesome. Yeah, thanks, Chris, and thanks for having me on. Really appreciate it. So my name's Chris. I grew up in Wisconsin, from the Midwest, but I'm living out here, of course, in California, SoCal, and Marine Corps veteran. Got all the degrees, bachelor's from UCLA, master's from Stanford in civil and environmental engineering, and I still do that for my day job. But what I'm really passionate about and what I'm doing on the side, as Chris alluded to, was real estate investing. And so this is kind of my vehicle, my path that I am taking toward financial freedom, time freedom, all that fun stuff. And I see a light at the end of the next 12 months. That's my goal, and I see a path to it, and I'm really excited and passionate about it and pushing toward that. And then I also help other folks get started in real estate as well, whether that be through actively investing like I'm doing, or even passive investments, partnering on deals, syndications, those types of things. I'm a little bit newer in that realm, but excited to kind of keep going that direction as I scale my portfolio. So
cool. So when you say the light at the end of the tunnel in 12 months, does that mean you're going to quit your regular job?
Now here's the question: is this going to be on LinkedIn? Because if my boss catches wind of that, she's not going to be too happy. But yeah, that's the plan.
Even if you don't, and I personally, I wouldn't probably if I were you, but that's me. But is that the ultimate goal at some point?
Yeah, definitely. So when I say light at the end of the tunnel, that is what I mean. And that's kind of, when you talk about financial freedom, I think there's levels to that. I mean, you can define that different ways, right? And So that could just be initially like, hey, I'm going to quit my job. I'm going to be self-sufficient with my, with a bare minimum lifestyle, right? And I don't need a job. I got enough passive income from the real estate to support me with that. But then another layer to that could be, in adding the lifestyle aspects to that. Oh, I want to go travel the world. I want to go, I want to start a family and put them in private schools and raise for their retirement, all these different things. So yeah, the 12 months is an initial starting point of freeing up my time by quitting the job so that I can continue to put more of that time and invest more of that time into the real estate. So in the long run, I'll have even more financial freedom to go off of. So yeah, it's just a starting point, a jumping off point. But so for me, I got a number in mind. I got to add 22 units to my portfolio this year. That's the big number. And so right now I'm at 7, but I'm under contract for 5 more. And it's closing. I mean, it's supposed to close middle of this month, but we're in the heat of negotiations right now. So hoping that we can come to an agreement and make the deal happen. So
Cool. So one of the things you and I talked about was, I think, education. Like you were talking about educating people about all of this. What is it you find people don't know about real estate?
well, that's a loaded question. I mean, so to start it off, how I kind of learned, and I'm a part of a group, that provides all this education. We like to start folks. This is how I started, in what we call the essentials, which the company I partnered with is an education company. This is what they deem to be essential courses. And so some common themes are, there's 2 whole days of tax and legal classes. So people think about real estate. Oh, I got this property. I'm going to go buy another property. I'm just going to rent it out and make some money, easy peasy. But there's a lot they don't think about, right? Obviously, you're collecting income. You pay taxes on that. However, there are some amazing tax benefits in real estate that a lot of people might not be aware of, the biggest one being depreciation. And I don't know if we want to go down that rabbit hole or not, but that's one definite area we could talk about on the tax and legal standpoint. Then there's creative financing strategies. So being able to buy properties with little or none of your own money or credit. There's all sorts of creative ways to do that. Um, Figuring out if a property is for sale when it's not listed on Zillow saying it's for sale for everybody to see, right? How do you find those properties and how do you know that they're likely for sale? How do you contact the owner? How do you find their information? All that stuff. And probably one of the biggest ones, and this is all in that essentials, is self-directed retirement accounts is a big one too. You can, a lot of people, that's the big hurdle. I don't have money to invest, but they got $100,000 sitting in a 401k, right? There's ways you can use your retirement funds, if it's set up and structured a certain way, to actually go out and buy real estate with that money. Not taking a loan, but that's another thing a lot of people, I think, aren't aware of, is you can also take a loan generally from your 401k. So lots of cool things.
Taking a loan from your 401k sounds kind of like, isn't that what, billionaires do with their investments? They just take loans on their investments and they never sell their investments. They just keep taking loans and
Yeah.
loans and loans on their investments.
I mean, that's the idea. Yeah, you use it as collateral. Now, the 401k is a little bit different because you actually have to sell some of your assets in there and then to loan yourself the money, if that makes sense. So um, they're not just giving you money and using your stock as collateral. They're actually selling some of that stock and then giving you the funds from those sales, and then you pay it back to yourself in the 401k account over time.
Okay.
Yeah, whereas like an investment property, the property itself is collateral. You don't have to sell anything. You're just you're just taking out a loan and signing on the dotted line.
So one thought I've been thinking about a lot as I watch all these YouTube people talk about money and retirement and the like, is the fact that I think what they say, 50% of Americans don't own any assets. So definitely not a home, but even like stocks and stuff, they don't tend to own. So they're not staying up with inflation when it comes down to it. I mean, how many people own a home today? Is that still the American dream?
Hmm.
I don't know,
That's a
Scott,
great
what do you think?
question. Yeah. Yeah.
Well, I don't know the percentage. I think you got to really differentiate what you do personally versus your investments. I mean, I don't really consider if you own a home as an investment because you got to have some place to live, right? So I consider that more as an expense. Now, it could be a good expense because your underlying asset goes up, which is better than it going down, but it really doesn't matter in my mind if it goes up or down, right?
Well, so this is an interesting thing where I know is it Robert Kiyosaki, Rich Dad Poor Dad, has this thing saying that most Americans think that if they own a home, they have an asset, but it's an expense, right? Because they have to pay it off, and they're
Yeah.
not making any money off of it. So I think that's the
Right.
argument you're making. And
Yeah.
yet, for most Americans in the last, I don't know, 100 years, that has been the route to building wealth, though, right? Because
Yeah.
you've got an asset, you're living in, you're using it, you're paying, but it's also gaining value over time.
Yeah.
So with less and less people buying them as buying a home, I think the millennials and younger, a lot of them don't even intend to buy property, or at least buy a home. That's a different thing, right? Some buy property as an investment without buying a home.
Yeah.
Yeah.
That's
I,
different. Yeah. That's
I think
different.
there's a big shift, in the younger generation toward just renting instead of owning, right? Nobody wants to sign for a 30-year commitment when they could sign a 12-month lease or a month-to-month lease, right? Um, Seems to be a trend.
But considering how the lack of education for so many Americans when it comes to finances, if they're not buying a home and they're not buying other assets, isn't that widening the class gap between the rich and the poor? Because if you buy a house, at least in 40 years it's likely to have gone up in value. It's not a guarantee, but
Yeah,
it's a pretty
almost certainly, depending on where you buy it, right?
So usually you'll be financially better off, not only because you've got more years of experience under your belt, you're probably making more money, but also you've built an asset over time, and you could sell it off at that point. But if people aren't doing that, then it seems like you're just building a generation of, you're expanding the class of people that will be the have-nots in the future.
Yeah. Yeah, I think that's exactly right. I mean, the problem is, you just lack self-control, right? Because you got to have the new iPhone, you got to have the big screen TV, or you got to have this. And it's like, okay, or you got to eat all the time. And so you're just eating your retirement is what you're doing.
Yeah, I think, Scott, I may have mentioned to you that I think it was in one of the Olympics. They had this commercial, and it was being done by a bank, and it would show somebody in a situation where they had like a Rolex watch, like a $15,000 Rolex watch, and they would say $15,000 today or $60,000 at retirement.
Yeah.
And it was a whole commercial just showing these things that you could have these items today, or you could have 4 or 5 or 10 times that dollar value in the future. And I just remember that commercial because it was like, yeah, I mean, why do I need a $15,000 watch?
Yeah.
And it's one thing if you're making millions a year, 15,000. I mean, you look at it as a percentage of how much you make, right? If you're making $100,000 a year, then $1,000 is 1% of your income.
Yeah.
Right. But if you're making $100 million a year, then $1,000 is what, 0.001% of your income. I mean.
Well, I mean, the more money you have, the more you can afford to be stupid, right? The challenge is that most wealthy people, they're
Aren't
not stupid. I mean, I know people that are worth, personally, I know people that are worth, I don't know how much, but I'd say $5 to $10 million. And you go around, it looks like they're poor, right? They drive an old beat up truck. They just like, why would I spend that money on a new car? It's like, I'm not doing it.
Like
There was
Buffett, right?
a book that came out in was it 80s? The Millionaire Next Door.
Oh yeah. Yeah.
And it was the idea that at the time they were saying like 60 or 70% of millionaires never made more than $100,000 a year. They drove
right.
around in 10-year-old cars. They didn't dress fancy. And because they became a millionaire through just mostly saving and minimal, moderate saving and investing, pretty much, right? They didn't go and buy expensive stuff. They bought the moderate house. They did all that stuff.
Well, here's my financial advice, which is sound, will be sound forever and always isn't sound, is you should be spending less than you make. This is,
Okay, so Scott, that applies to calories in, calories out too.
It does. Not exactly.
You should be
More
eating less
complex.
than you burn. Actually, I guess that's the opposite. No. So that means calories are the opposite. You should be taking in less than you burn.
Yeah, that's
Whereas
right.
money,
And it depends
you
on.
should be taking in more than you burn.
It depends on what
Financial rules are the opposite of health fitness rules.
Yeah, and ideally, if you're going to spend your money, I mean, I would advise against. I want to say this, but I'm going to say it. I'd advise against spending it on cocaine and hookers, right? Because you don't get anything. At least, if you're going to spend your money, at least buy an asset, that you could possibly resell, after you wake up.
Oh, you mean like a brand new car?
Even a brand new car is probably not, especially now, is probably not a good idea.
Well, with the car situation, one of the guys in our group who he's a high income earner. He's actually I think he's the top income earner in the whole shebang, the whole company. But he asked his wife once. He's like, Nancy, I really want a Ferrari, and or no, it's a Lamborghini. I really want a Lamborghini. And she's like, yeah, okay, you're crazy. That's not going to happen. He's like, all right, well, what if I could buy the Lamborghini with none of my own money or credit, just like we teach in the real estate classes for real estate. And, I made it a business where the income from the business paid back my investors. And so I never put any money in the deal and it actually makes us money. She's like, all right, if you can somehow prove that to me, then sure, go buy your Lamborghini. And I don't know the details of it, but he basically, he pooled money together from his buddies who were investors and gave them a return on their money. And I think the business was basically, honestly, it sounded somewhat of a Ponzi scheme to be completely transparent. But from what it was explained, it was like, hey, he had logos on his car or whatever, and a website on his car, and then people buy your own Lamborghini with none of your own money or credit, and then they'd go online and see how he did it, and then they'd go do it, and people invest in there for them to go buy their Lambo and whatever. So, but he did it, and he made money off of it.
Yeah, I mean, and generally, the challenge with that sort of thing is it sounds creative and it sounds cool. How much time do you have to do that to get the Lambo, and then how much risk is there? And this is it's not like I'm against investing in real estate, but one of the risks that are in real estate is you're typically doing with highly leveraged money, and there is risk. I mean, the asset does go down sometimes. It just doesn't go up forever. And especially if you're, buying assets and then highly leveraged and you loan against that to buy something else. I mean, I know people, again, personally, who have had 10 or 15 houses. As soon as the market went down, it just crumbled like a house of cards and they were nowhere. So, I mean, especially as I get older, I'm always looking at how much risk is there in this transaction that I'm going to be doing.
I was listening to a guy on YouTube this week, and he was talking about the housing market in different parts of the country. So he was saying, like in Florida, I think it was, they had built a whole bunch, like 50,000 new houses, and all kinds of stuff was going on. And so the price had come down on a lot of housing in the area because there was a surplus of it. Versus in California, where it's so hard to build anything, the price stays high. Even though we have a high demand, it's just so hard to build. And so in many ways, if you can afford to buy in California, you're probably have less risk of it going down because the structure, the government red tape here to build anything is going to make it just cost prohibitive to make anything really cheap. So,
And especially in Orange County, it seems like prices only go up, and I'm just, I mean, but man, there's always the, and I think a lot of people, when they invest, they only look at the bright side of things, and they haven't, I want an investor that's gone through a tough time as well, too. And especially young people, they think, oh, it's only going to go up forever. And I was like, no, stuff goes down sometimes. and it can be very painful.
Well, whenever we're looking at a deal, how I mitigate risk, how everybody that comes into our group mitigates risk is we always recommend at least three we call exit strategies. So if your primary strategy is to buy and hold a rental property, I mean, for me, number one, my plan is to hold that sucker, just to hold it. I'm not planning to sell it. So I frankly don't give a shit if the price goes down, right? Because I'm getting rent, I'm getting cash flow. Now, I don't know if something populations start moving out of that area, new builds start popping up. I don't know, maybe it becomes cheaper to build than it is to buy. And all of a sudden there's less renters and the rent starts going down. I don't see that happening soon, but it could, right? That's always a possibility.
Possible,
if that
yeah.
happens, that's why I still like to have other outs, or maybe surprises happen that you weren't accounting for when you were
Like a
purchasing
fire.
the property.
Like a fire that
right?
wipes out neighborhoods.
Yeah.
The insurance companies won't pay because they don't have the money to pay for it.
I
Right?
don't have an answer for that one, but
It's planning for a natural disaster is tough, because they're going to happen no matter what.
Yeah.
And we can go into whether those fires are natural disasters or not as a separate conversation too.
Oh, you're always looking for a good conspiracy, aren't you?
No, not even a conspiracy. It's the fact that we know these things happen, and we don't plan. The government makes a risk assessment and makes it, or no, they don't, that's the problem, right? If the government were to sit down and do a risk assessment and say, you know what, if these places can burn down, we should spend more on fire departments or whatever, they can make a plan and go, you know what, we don't have enough money to cover that, so it's a higher risk. If they had done that, then I would have said they'd done their due diligence. But I don't even think they think that way. I don't even think they recognize where the risks are, which is why I get upset with government being substandard and not coming up to the level, right? If a business takes on a risk and knows there's a risk and makes a decision to go forward anyway, then they've done a risk assessment, they've done their due diligence. Right. Where if they don't even know there's a risk there, then they've screwed the hell up. And that's where I think our government tends to be in a lot of places.
Yeah, no, that makes sense. And so I don't know what's going to happen to that whole neighborhood in California. That's going to be a big
saying
problem.
What, $250 billion, biggest fire in California history, biggest fire, I think, maybe the biggest the biggest disaster in American history. I don't know.
I know, it's crazy. Yeah, so it's interesting. I mean, you got to look at. I don't know what you call that kind of risk, but it's sort of. I guess that's just, an act of God kind of risk, right?
That's why you buy in Arizona, where sandstorms are about the only thing you need to worry about. Because here we got earthquakes, we got fires, right? We get the rains after the fires.
Rains after the fire. And it's crazy. It just happens over and over and over again. And it seems like you'd learn after a while,
Chris, Scott is in Arkansas. That's why he's got the AR on his house there. He used to be in Orange County, though. So gotcha. What other natural disasters you have to worry about, Scott? Do you have tornadoes where you're at?
Oh my God, tornadoes are horrible, actually. In fact, it's raining. In fact, we've been having tornado warnings for the past 2 or 3 days. It's a little freaky,
Yeah, I mean, that's something I've never had to, aside from watching, what's the original, Somewhere Over the Rainbow, Wizard of Oz? Aside from that, I mean, gonna pick up your house and you're gonna go somewhere else.
Yeah, it's pretty crazy. And the whole thing about tornadoes is they're very selective. I mean, you could literally, your house could be fine, and it could be the one next door could be completely destroyed. It just depends on, what it wants to do.
Have you experienced that yourself? Any tornadoes?
Yeah, we had one really close. It knocked down a bunch of trees. I mean, it was scary. I'm like, oh my God, are we gonna die? Because the light was literally at night, the lightning was flashing so fast with just like strobe lights going on. It was like green, and we're standing by the window, and you're like, not supposed to stand by windows because stuff comes in.
A tree comes through and breaks the glass. Yeah. Do you have a cellar? Do you have an underground cellar?
No.
So
what I do is I just
the bathroom.
The same time I just go to bed and just pull the covers over my head.
Pray.
Right. I know it's not the best risk, mitigation strategy, but what else are you going to do?
Okay, so that's one of the projects you could do, right? You could dig make a bomb shelter or so, the equivalent thereof.
Yeah, I think that'd be kind of cool. Or it's interesting. I was watching some YouTube videos, and there's the way we construct houses has just been done this way for a long time, and they're kind of dumb. I mean, you can actually build like a concrete house that will stand 200-mile-an-hour winds all day long, no risk, and but it's just not done for some
Yeah, well,
It
you
reason.
wouldn't
sounds
do that
like
here because that concrete house would fall apart in an earthquake and crush you. So, yeah.
Yeah,
I
exactly.
remember when I was living in Japan years ago and the Kobe quake happened. So this would have been
Mm.
what, late mid 90s, early 90s. And the houses that didn't fall down were the ones that used 2x4 construction following the American construction techniques.
Oh,
The
interesting. Yeah.
traditional Japanese ones fell down. And
Wow.
so there was a lot of interest afterwards in U.S. Construction techniques because even though we use 2x4s and then we have like angled framing ones to hold them in place or whatever. So you get the triangle, which is one of the strongest support mechanisms.
Yeah, yeah, right.
And what they found is that they allowed sway without falling apart,
Yeah, you
whereas
can
something
move a
that's
little bit. Yeah.
stronger doesn't allow the sway, can't absorb the movement as much. So I found that to be really interesting.
Yeah,
But
it is. It
even
is.
like that quake in Thailand last week, which killed a couple thousand people,
Oh yeah, I
right?
don't watch the news much anymore, but yeah, I
So
think I know what
all
you're talking
the all the buildings that collapsed, and we're talking high rises, were all Chinese built. All the ones that stayed were the Japanese built ones, or the ones that were built from countries who have experienced earthquakes in the past.
Yeah, right,
And
right.
so there's a lot of investigations now there as to like, well, what kind of substandard or what construction, that sort of thing that happened. But
Yeah, this is sorry to do this to you, Chris, but this is always like coming back to jujitsu in some way. It's like, right, no matter what your technique, no matter how good it is, at some point you got to pressure test it, right, just to see where your limits are. And people have this weird thing in their head, and I'm, the older I get, I want to diversify more because bad stuff does happen. And when you're young, you just can't even imagine. You just can't even imagine because the sun's shining right now, everything's perfect. What could possibly go wrong, right? Well, there's always plenty of stuff that can go wrong. As one of my mentors told me, he goes, Scott, it can always get worse. Thanks for the positive side thing.
yeah, yeah.
So I would like to diversify like my assets. I'd want to diversify geographically if I hold on to assets. I mean, to me, holding a single home is a lot of risk if it's a
Yeah.
big chunk of assets, and even man, I don't if I did this, I don't want to own homes all over the country. I guess I don't know what I'd want to do. How do you diversify, Chris? How do you diversify your holdings?
Well, um, honestly, so it's a good question, right? Because there's kind of two philosophies. There's the one that you just said, where have properties all over the place, and then the other is, well, if you put everything in one place, then you get economies of scale and cost efficiencies and things like that.
Yeah,
And so I'm kind of right now, as I'm starting to build my portfolio, I'm really more focused on one area,
yeah,
which currently is the Midwest and specifically Wisconsin, where I grew up because I know the area,
hmm,
and I have friends and family there. I have other investors in our group that are locally there as well. And so I built my team out there. Now, some investors they don't care. They'll buy properties wherever the numbers make sense, and then they'll build their team. And so they do it a little different order. I tried that all of last year, and I really didn't do any deals because I was just all over the place. I
yeah,
was like scatterbrained. Oh, there's a deal over here. Let me go look and let me, contact 10 contractors and 10 property managers and see if somebody can go walk the property for me. And then it falls through. And then, now the next deal is on the other side of the country and I do the same thing. And it was just a giant waste of time. So I'm like, all right, I think it's a better use of my time right now to focus on one area and build it out there. And what I will say though, and I definitely agree with, if you just have one single family home, that's way more risk because if that one tenant, if that one unit isn't occupied, you're paying the full mortgage,
yeah,
right? Out of your own pocket. If you have a duplex, your vacancy rate can go down.
yeah,
And if one unit's empty, the other one's paying, at least you're not covering the whole thing.
yeah.
And it just kind of goes up from there. So that's why I'm excited more about and when I say multifamily, I'm really looking to get into 8 units and above, after this 5 unit goes through. So
Yeah.
Yeah, I think that lowers your risk a lot, just because you have all those folks in one place. You really build a strong team, and then you can start to look elsewhere when you got a strong portfolio working for you there. So,
Well, once you've got that, not only have you learned and built your economies of scale, but then you can start specializing in other skill sets and always go back to your main team to help augment that, right? I mean, if you need certain services done and you've got a team built somewhere, you could
Yeah.
leverage them elsewhere, right? So
Yeah.
just
That's a
because your
different.
home base is Wisconsin doesn't mean they can't be doing remote work in other places once you've got that built out.
Yeah. And that
well,
assumes you're working in the business, right? Because that's not a passive
I see
investment.
your face. You're going, well, yeah, but there's things you need to do on the ground in the
yeah,
location, right?
that's more what
Yeah.
I'm saying. Like the remote stuff is really what I'm kind of doing myself. But I know that as you know, other investors like so Brendan Turner is one investor I listen to a lot. He's he was big in bigger pockets and now he's kind of doing his own thing. But he he's a big advocate for VAs, virtual assistants, right? He's like, look, as you scale, you're going to need the help, and there's just some really mundane tasks that you can teach somebody else to do, and you know they'll do it for very low cost and do a great job. So there's stuff like that could eventually be part of my team. Right now, I'm not at that point, I don't think,
Build
but
an AI agent. I mean, Scott's trying to build one right now, right? So
there you go.
Yeah. This is so, man, it's so funny because now what happens is now investing really turns into a business, which is a whole different thing, which means it's a lot of work. And
Oh, it is a business,
I mean,
absolutely. Yeah,
and things can go wrong. And my thought, like, I'm kind of, I got a negative personality. So I'm good in one sense because I'm always looking at the downsides of things.
yeah,
But, from what I've seen recently, I thought, oh, no problem, right? We can just get insurance. We'll cover against the really severe problems against the asset, right? Getting
yeah.
knocked down, fire, earthquake, or whatever. Now I'm not so sure. I mean, there's cases all the time where insurance companies are like, no, we're not paying for it,
well,
right? I know you paid us, but
so
we're not doing it.
I've got a problem right now with insurance on my rental property. I had, it's a condo, so there's a master insurance on the entire
Yes.
building, right? But
Yeah.
I had insurance on the unit itself. So if I have to if something happens, I have to do the inside of the unit, right? Because
Yeah.
that's not
Right.
covered under the master proper. And I totally missed the renewal payment on the insurance.
Oh boy,
So
Chris.
and so this was December, and I realized it last week. So now I've been spending the last week trying to find insurance, and since the fires happened, a lot of companies aren't taking new policies, particularly condos and particularly
Hmm.
rental properties. So
Yeah.
I'm having a hard time finding anyone to do this insurance right now. And
Yeah.
luckily, it's paid off. I don't need the insurance as part of a mortgage or anything like that. So I'm lucky in that sense. It's not a requirement, but it's to me, it's
Gotcha.
common sense to have something like that. And the stuff I'm finding is 4 times the cost I was paying.
Yeah.
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 So it's just crazy.
Yeah, it shouldn't. I don't know. I have one of my rentals. Well, my rental out here in Santa Ana is a condo, so I'm familiar with that. And now I use USAA, but they're veterans for veterans and veterans
Yes.
families. But it's pretty cheap. So I would hope there would be a comparable cost to that. You might want to. I don't know. I always check NREIG, NREIG. I think they're kind of more of a. I think they might broker it out to other companies or something like that. But they special. It's National Real Estate Investing Group or
Okay.
Insurance Group, but they specialize in investment properties. So
So maybe I'll look at that because
Wonder.
where I'm going is I specifically say landlord insurance,
yeah,
and then it routes me into the regular home insurance. And so I've been getting phone calls 5 times a day, and they ask and they're trying to say, and they're just farming it out to some agent, and I have to say
Yeah.
first thing before you ask me any questions, this is what I'm looking for insurance wise, and that shuts them down. But I mean,
Okay.
it's such a niche that the problem is there's no real process or automated process, so they just
Yeah.
just push me into the home insurance plan. So
I mean, yeah, I don't know. I could send you a couple of names of insurance brokers
yeah, let's
out
reach
here.
out. I'll reach out to you afterwards, and that'd be great. So
Cool. All right.
So
But-
Chris, is that a good idea? Do you think to have a single property? I mean, why don't you just sell it and just put it in the market, put it in an S&P 500 index fund or something?
I consider it right now my family's insurance policy if anything happens to me. That it's a condo is in Irvine. It's a 1-bedroom with a loft. It's very easy to rent. And I've thought whether I should turn it into something like an Airbnb. I don't think it's an ideal type of property for an Airbnb or
Yeah.
something like a short-term rental. And I have a guy in there. I mean, I have not maximized the rent on it because the tenant I have in there he's older than I am and makes more money than I do. So
Yeah.
in my mind, he's the ideal tenant, right?
Mhm.
And I I would love to have one or two more properties like that where just because and I paid it off, right? Because I bought the house in 2002 and we lived in it for 8 years, and then I turned it into a rental property after that. So I got to figure out all the tax stuff you're
See,
talking about.
you're smart. You paid it off instead of refinancing like every other American does.
Yeah.
And that's
So
what I was gonna say
I did
earlier.
refinance it once in '07,
Yeah.
'08, I think it was.
I mean,
But
sometimes it makes sense, but like when we were talking about, your primary residence, whether that's an asset or a liability, the fact is like most people live in their place for 2 years, then they refinance, and they live in
they
another
pull,
2, 3 years,
well, then when they
refinance.
refinance, they pull money out. I've never pulled money out of my
Yeah,
out of
yeah,
when I refinance. So the last time I refinanced my home here, it got down to 2.9% was the interest rate, and so I locked it in at
wow,
2.9, which lowered it from like
right.
6% as where it was before. So it was worth
There,
it.
there is something interesting though to be said about your risk when you don't have a loan, especially in California. In California, you want to do everything to mitigate your risk, right? And so obviously insurance, you definitely got to get that
Yeah.
in place. That's huge, but also, and then if it's not in an LLC, I would strongly suggest
Yeah,
you
so that's the other thing. So it's been
talk
on
about that.
my
Yeah,
radar for the last couple of years. Is I really want to put it into an
yeah,
LLC. I also want to figure out how I want it structured with a family trust and all that kind of stuff. All these are all things that,
yeah,
again, as you get older, you need to learn these things, and I kind of just ignored
yeah,
them for the longest time. So that's one thing I need to set up.
yeah,
But I think I may have mentioned to you one of the goals I have is to be able to set up a family trust or an LLC or maybe an S corp or something like that to be able to pay
yeah,
my daughter a salary from the management of this,
right,
so that
Yeah.
she can actually then take that. She'll
yeah.
have money, so as a teenager she can spend it,
You,
but
you
she'll also
know,
be able to invest it. I start a Roth IRA. I mean, by the time she graduates college, she may never have to worry about retirement again, which is amazing to
I
me.
feel like, yeah, I feel like one, definitely, I would get the LLC ASAP. And you can, and then the trust as well. And the trust could be the single member of the LLC. That's, if you just have one property and one LLC, that's the easiest way to set that
Yeah,
up.
I heard that some people what I had heard was that it's not that expensive to set up an LLC. So setting up one LLC per property actually simplifies if you need to move those properties at a later point, right?
Hmm.
So instead of selling the home to another person, I sell the LLC to another person, which is a different kind of transaction, right? So
Yeah,
I don't know. It sounded like a really interesting. You're basically packaging up each property under an
yeah,
LLC, and then you would have a holding
yeah.
LLC or a management LLC over those.
That might make sense out here because property values are so high. Yeah, um, generally, some people just do that. They just do one LLC per property as risk mitigation. Um, where I'm investing in Wisconsin, that just doesn't make sense because the property values are so low,
Mhm.
and it's just
What
an
is
administrative
housing run in that
nightmare.
area?
What's that?
What is housing run in that area?
Depends on the area.
Yeah, no,
If you're
admittedly,
looking
but
in, I was gonna say if you're looking in North Milwaukee, which is basically like south side of Chicago, it's
okay,
rough, man.
all
It's
right.
it's very rough. Okay, but that's where my 5 unit is that I'm looking. All right, so I mean, 50,000 a door,
Oh,
fifty
really?
thousand dollars a door,
So you're talking
or less.
250, 300,000 for the property with multiple units on it?
Yeah, so the 5 unit right now we're under contract for 239, and
Wow. Okay.
like I said, we're still negotiating because we found some stuff. We always find stuff during the inspection because these are old houses too.
Yeah.
But yeah, believe it or not, okay, this is kind of a tangent, but this is crazy. Most of the country, okay, um, the value of the land is maybe 20% roughly of the total value of your property. And that's important because you can only deduct or we call depreciate the value of the actual improvements on the land. You can't
Yeah.
depreciate the land.
Mhm.
So, but okay, in Milwaukee, this property in Milwaukee, 99% of the value is the improvements. 1% is the land.
So the land is worth
The
$3
land's
grand?
worth the land's worth like $1,200, so even less than 1%. It rounded, I think, Yeah, it's crazy. It's crazy. And then my stepdad's like, "Well, why don't you just go buy a bunch of land and build on it?" I'm like, maybe. I don't know. I don't know what the cost to build. I haven't really looked into that at all, but and also, in that neighborhood, I don't know. It
Well,
just
you'd give up the headaches of maintenance and worrying about an old property, but you'd take on all the construction headaches.
yeah,
So
yeah. But it's an idea, all right? It's an idea. And there are a lot of empty lots in that area too. Just because so many
that would be
properties
an
just got run
interesting.
down. Yeah.
Once you get your business set up and you've got it at a point where you're comfortable with it, then you just go, you do a little mini project and see what it's like, and then you can
Yeah.
grow from that, right?
And
I
hey, I'm
mean,
a civil engineer, so I can get a lot of the permits myself. I can do a lot of the
that's
drawings
good.
myself and all
Yeah.
that. And then the other interesting thing is out here in California, at least, and I only know I have owned 2 condos out here, so just I only know from that perspective, but it's literally the opposite. The land is like 80% of the value,
Mhm.
and the improvements are
Well,
20%.
I think my condo, when I looked at it, it was about 40 to 50% was the value of the land, but my
Okay,
house is probably closer to 70% of the value is in the land.
interesting. I
So,
just had this property I'm in right now. I just bought in July. The previous tax assessment was roughly what you just said, like 40% land. Um, I just got the reassessment. The land somehow the improvements, like, sorry, I'm forgetting the numbers, but anyways, the land went up. It was like the whole increase. The land went up from like 70,000 to $340,000, and the total purchase was 460. So,
well, so
um, yeah.
in California, though, we've got Prop 13, which keeps our property taxes from growing too fast, right? Scott, where you are, do you have any idea what the property tax is?
I don't know. I know they're not very much. I think like my total, it's about $2,000 a year for my total property taxes. And
What percentage of value is that, though?
oh, I don't know. I
What
mean,
is
you
a
could
home
pay,
in your area running?
let's say 300, and so I'm paying two. What is that? So that's
Oh, less
less
than a
than
percent then?
1%.
Less than a percent, yeah.
Yeah,
Yeah,
less than
I
a
think
percent.
7%.
I think my area is like 1 point something percent. Under
Yeah,
one
we're
point one
around a
percent.
little
It's
over
like
one.
1.05 or
Yeah.
1.07.
And it's
Yeah.
interesting in Arkansas, you pay after the fact, as opposed to in California, you prepay, I believe, right?
Oh, you mean at the end of the tax year as opposed to the beginning or during the
Yeah,
tax year?
right.
I see.
Yeah. Yeah. So
Yeah.
we'll get our tax bill pretty soon. Come in. In fact, I think we got it already. But then
Oh
it's
crap! What day is
due
it?
immediately, but it's not late until
It's
like
due in
sometime.
5 days. My second payment's due in 5 days.
Oh my God.
You write that down.
Yeah, but that includes everything. That
Taxes
includes
and
all our
insurance,
cars.
Chris, come on.
Ah,
It's
I'm a
hard when
horrible
they don't
landlord.
impound it, right? It's hard when they don't. You don't have a mortgage, so they don't take it out automatically. So,
Yeah.
Well, I never did that. I never liked the
oh,
idea of them taking money out. So I've
yeah,
always separated those
that's good.
payments. So one thing you were mentioning this property, this 5 unit property. I remember when I was looking for a condo back in 2000. So this is 25 years ago. You used to be able to find HUD homes. Housing and Urban Development. Is that the department? You could find HUD homes that had been I don't know was repossessed or whatever the term would be,
Mm.
relatively inexpensive all over America. I remember there was a 5 bedroom freestanding house in Idaho for 28 grand. There was a 2 bedroom unit rental property in Long Beach that was going for 200 grand. And so this is 25 years ago. So I mean, but I looked at it and said, oh, it's got mold, so you need to do some mold work on it. And I'm like, oh hell. And at the time, it was my first home. I wasn't really thinking about buying a rental property, but now I look at it and go, damn, if I just bought that, right? I mean, oh,
Yeah,
I don't think there are any HUD homes anymore.
hindsight
I think
for
the housing has changed so much in the last 20 years that there's never anything on the HUD homes websites anymore.
Yeah, I'm honestly not too sure. I know that they've kind of restructured things a bit, right? You no longer have the HUD forms on your closing statements. Now it's a closing disclosure. Like a lot of things change after the financial crisis.
I
Um,
wonder if, yeah, even if
this
there were HUD homes, I bet you companies like BlackRock and stuff just buy them all up,
probably,
right?
probably.
At,
Yeah,
at,
yeah.
at that price, yeah, the land in those scenarios, they probably look at the price of the land and say, we can just tear it down and do a rebuild.
Yeah, but there are like REOs where the bank tried to foreclose on a property and then nobody uh, they wouldn't pay enough money to basically give the bank back their investment, so they kept the property and sit on it. So there's stuff like that. Um, yeah, a couple of my friends are looking in Detroit area, and they have like land bank auctions out there, very, very cheap uh, properties. Well, again, it gets bid up. I mean, it's an auction, but a lot of folks find that that's a kind of an easy way in at a lower cost, but generally there's a lot of work that needs to be done with those properties too.
At
So,
my old company, I used to joke that the company should move to like Detroit in one of these neighborhoods, just buy up the whole neighborhood so we could all live there, and then you don't have to
right?
commute far.
Yeah. So I've thought about that. Yeah, see, I got a squirrely brain, right? The engineer mind. So I'm like, last year it was all over the country looking at deals, and then I'm like, all right, I'm gonna zero in on just I couldn't just force myself to zero in on one place. So I'm like, all right, I'm gonna do Wisconsin, Indiana, and Detroit. I'm gonna do those three places, and I'm like, oh, and North Carolina, so those four places. And then I'm just like, you know what? The more I got into it, I'm just like, all right, Chris, just focus on Wisconsin for right now. You can always expand later, but I do think there's a lot of opportunity out there in those other areas too. So
So, uh, is it Section 9 that's the government
Section 8,
program? Is that
Section
Section
8,
8? Section 8.
Section 8, yeah, yeah.
So, and that's
Housing
one where
choice
you rent
voucher.
it out to a lower income and then person, and then the government augments that. Is that how that
Yes,
works?
yes.
What are your thoughts on that? Because I have underlying opinions that have no basis in fact that it's a negative thing.
Well, I'll say that number one, I'll say I haven't used it yet, but I'm very interested in it, especially on this 5 unit. It works. It can work, and it can work really well in super low income places like North Milwaukee, South Chicago, Gary, Indiana, Detroit, right? So the way that it works well in those areas is that the government will actually approve higher rents, much higher rents sometimes than market rents. So it's a benefit because it's not attractive. Like for whatever reason, a lot of investors just there's an ick about it, right? So a lot of investors stay away from it. My opinion is, look, if you're gonna go in that area anyways, um, why not have the government guarantee majority of your rent? And I know a couple folks, again, in our group, one that both of these individuals, they invest heavily in Chicago, and one of them's moving. He's selling all of his properties and moving all of his investments to Gary, Indiana, but it's going to be the same deal over there. Um, but they both have had amazing experience with Section 8 because not only is it guaranteed rent, but um, the tenants are incentivized to behave because if they act up and they don't follow the rules, they can get booted out of the Section 8 program, and then what the hell are they going to do? They're fucked. They're on the street.
That's my so that's interesting because that's always been my worry, right? Is like the quality of your tenant
Right.
is gold in my mind, right? And so when I would be looking for a tenant, I had ideas. Yeah, I can't discriminate. There's certain things you can't discriminate on, right?
Yeah.
But there are
Including income. In fact, you can't discriminate on vouchers. If they come to you and say, "Hey, I got a voucher," you can't say no.
yeah. Well, so but the idea here is, I don't want to sound overly racist here. Actually, it's not racist. I guess it's when you base it on someone's economic class. What is that called? It's not racist, right? But the idea here is, I find people in certain fields, with certain incomes, with certain educational backgrounds, I tend to have a different expectation of their behavior.
Yeah, for
right?
sure.
And it's not that people in lower economic settings can't have great background in behavior. It's just I have kind of a default expectation, and so that creates a bias in my mind. And so that's always been the problem. Although I had a friend who had a condo in Santa Ana, and when she moved out of Orange County, she rented it out and used Section 8, and she seemed to be perfectly happy with it. Again, it wasn't an expensive condo unit. It was an older unit that she rented it out of. So
yeah, what I would say is, if you're not comfortable with that demographic, because one of the first things that we figure out before in our group is, who do you want to serve, and that helps dictate what strategy you use and where you want to invest and what demographics you want to invest in or serve. So, and the instructor breaks it down as, are you a Walmart? Are you a Walmart person, a Target person, or a Nordstrom person? And do you want to? And they all have their headaches, right? Do you want to deal with the lower income, and it's stuff that you're talking about that you don't sound comfortable with? Do you want to deal with the middle class, or do you want to deal with the upper class, who's going to complain about, hey, hey, I don't know, right? They can't screw in a light bulb, or they want
to change the color of the bathroom.
Yeah, so just like really basic things that normally a lower income tenant or a middle class tenant they're not even gonna call you about. They're just gonna fix it, right? The upper class isn't. So there's stuff with all of them. So that's kind of one thing that we like to pinpoint right away. Now, I will say, generally, I grew up middle class, so I generally like that. But at the same time, I like money and cash flow. And these Section 8 properties, it's just so hard to pass up, man. Because when I'm saying there's a discrepancy in rents, I mean, market rent on a 2-bedroom in this area is about $900 per month. And Section 8, if you include all utilities, because that's their basis point, if you include all utilities, it's $1,400 versus $900. And if you require the tenant to pay all utilities, it's about $1,200. So that's 33% higher with the tenant paying all utilities. So it's drastically different. You get into 3 bedrooms, now you're talking, I think it's like $1,750 for rent, which is crazy for Wisconsin. So it's a big deal. So I'm gonna try it and just I'll find out if it's worth the headache. The other beautiful thing, though, is that I'm using a property manager. I would not do this and manage it myself, because everybody I talk to who owns property in this area, Southside Chicago, Gary, Indiana, Detroit, they get concealed weapons permits, and they always carry when they're going to those properties, because shit goes down. It just does. And I mean, it just... And the first time somebody told me that, I'm like, okay, dude, I was in the Marine Corps. I'm fine. I live in Santa Ana. I've lived all over Santa Ana. There's been stuff happening. I don't think I need that, but I don't know. The more stories I hear, the more I'm like, all right, maybe I just won't do that.
Scott's prepared for that.
Yeah.
So I have a rule about this, right? If you think you need to take a gun somewhere, don't go.
Then what? Then don't go. Yeah,
that's my rule.
Yeah, so. Especially Scott says he won't carry a gun because it's uncomfortable to wear. Is that what it was?
It's a pain in the butt because it stabs you in the side. I mean, here in Arkansas, we love our guns. Everybody's got guns, right? The super nice, principal lady next door has a gun, and she carries it around with her all the time. She's like So of course you're asking me like if
Yeah.
I have a cell phone, right? It's the same
Very
thing.
different culture than where we live, I would say.
Yeah, but
So
still, with
so
that being said, yeah, don't go if you need a gun, because you know if you're gonna be, because just because you have a gun doesn't mean anything, right?
Yeah.
so Scott, what
Because
is the
most of the,
Nordstroms of guns? The
what's the
Nordstroms of
Nordstrom of guns? Oh my gosh, I don't know what the Nordstroms of gun is, but I will tell you. Are we talking handguns or we want rifles?
Well,
What
I
are
would
we talking?
assume handgun if you're I'm imagining these
Walk
property
around with a
managers.
rifle.
So he's talking about property managers going to these bad parts of town, right, and needing to carry a weapon. I'm like, so if you were to go to like a rich part of town, what kind of weapon would you need to carry to fit in?
Well,
Nerf
here's
gun.
because I know you want to get a gun, right? Here's what I'd recommend: go get a Glock 19. It's just the good all around. It doesn't do anything great, but it does everything good, and it just works. You don't even need to clean it if you don't care about cleaning guns. Just it just goes bang every single time. Get a Glock 19.
There
But
you
you
go.
got to understand, a gun. Oh man, just a gun does not make you safe, right? In fact, if anything, you may become more dangerous with a gun
Because you think you're safe.
because you think you're safe, right? So
Yeah.
if you're going to get a gun, please train consistently with it. Know how to use it. I mean, it's just, yeah. So, anyways, that's my thought on guns.
Yeah. I'll leave it to the property manager. So I'm like,
Well, so what are you paying for property management? Like, is it as a percentage of of the total
yeah.
rent?
So generally I mean, I pay 10%. That's pretty average
Okay.
of what they'll charge. But you will see that vary. If you only own a few properties, it's like 8 to 12% is the range you'll likely see.
Mm-hmm.
Anything more than that, it's too much. And anything
8 to
less than
12
that,
of
they're
your
probably
gross
not going to do
rent,
it.
of
Of
your
the
total
rent, yeah.
rent. Okay. So,
Um,
wow. So then, okay, so let's do a little break-even analysis here then. So it sounds like if you're going to do this, this is not passive investing. You've got to be actively involved in it. So besides the risk of the investment, how much time do you need on a monthly basis to do that? Because let's say you're in California. I mean, most of the time, if you're in technology or doing something, you're making at least 100 grand, if not more, right? So how many properties do you need to even just get to break even?
hmm.
Well,
And then you got
Yeah.
to
So,
factor in the additional risk of that as well too.
but you're talking about like in his method where he's
well,
buying in like Wisconsin, how many properties he needs? Is that what you're
Yeah,
asking?
yeah.
Okay.
all right. So my 22 units is not to break even. It is below that. Why? Because one, I'm gonna get out of this state for
Mm-hmm.
a number of reasons. But so my cost of living goes down. Two, when I move, I'm gonna house hack, meaning I'm gonna buy likely ideally a 4 unit, live in 1 unit, rent out the other three. So I won't be paying much for that house as well. So I'm gonna
Yeah.
minimize my expenses so I can, and so that the 22 units is enough to sustain. So I did a whole projected budget and all this and added in contingencies and things like that as well. But if you just said, hey, if somebody made $100,000 to replace your income and doing long-term rentals, generally I go for $200 per month per door
Okay.
Okay.
per unit. So 200
So
times
5
12,
units per $1,000 that you
20,
need a month. So if you need
2,400
10,000 a month, you need 50
Yeah,
units.
so let's see, 100,000 over 12, 8,300 a month.
500, right?
So it's a lot, it's 42 units, 42 units. But again, that's why I'm going to multifamily because you can buy one property that's 42 units, right?
Yep.
You don't want to probably start there. You want to get some experience. So I'm really taking this stepwise. I started at condo. I went to single family. I went to duplex. Now I'm doing 5 unit. The next step, when I get to 8 units plus, I'm going to have to partner with folks because I just don't have the capital to be putting money down unless I get really creative on the deal structure which would be great, where I don't need to put anything in the deal. But likely I'm going to need capital. So I'm going to need a partner.
And are you
So
pulling capital out of what you already have to invest in the next one?
not yet. No,
Okay.
yeah. I've only been doing this for 2 years.
Okay.
Yeah.
Well, I remember like some of the big real estate guys and over the last 20, 30 years, I mean, they just keep borrowing money on what they
Yeah.
bought. And then they,
Yeah.
you know.
I yeah, there is one single family home that I own free and clear, but it's a really dinky home. It's not worth very much, and so it's hard to refinance because a lot of the banks, they won't even give you a loan for um, less than 100 grand, and the
Yeah.
property's not even worth 100 grand. So
Yeah.
so that's been a challenge. So there's a lot of lessons I'm learning. I'll say that.
Yeah.
So
If the loan's not big enough, they're not willing to, it's not worth their effort.
It's
Right.
not
I mean,
right,
that's,
right.
so
And
so what's
the
your
cost of
rate
me
of
getting the loan is now a huge percentage of even the price of the home, the equity. So that home in particular, I am strongly considering, if it keeps giving me issues, I might my next, like I said, I like to have multiple exits. So my next exit strategy would be to sell it on seller financing. To I would offer it to the tenant who lives there because she's been paying her rent on time just fine. And here's the cool thing with this property is her payments could be exactly the same as what they are now, would not change, and that would include taxes and insurance. Um, but my cash flow would go up because now I don't have vacancies, I don't have repairs. They're handling that, right? I don't have property management. I don't need any of that. It's just straight up seller financing. I don't get the depreciation because I no longer own the property.
mhm.
Um,
and you
so there's
don't get
been,
the increase in asset value as well. You give that
yeah,
up, right?
they get all the appreciation
Yeah.
and all that stuff. But at least then it would get rid of the headache. It would strip out some of that equity because there would be a down payment from them too. I would keep getting the cash flow, and then I could go on and find some other
Find something
properties.
else.
So
Yeah.
So have you done an analysis of like what it would take doing this at a purely passive level to equal investment, let's say S&P 500, right? Let's just call it 12%
oh
annual year, right?
oh okay, from a passive level. So you're saying just basically like giving me money to go invest in a deal,
Yeah, so
and
let's say you get 100 grand, right?
yeah,
You invest it in, and you can't really do it in a Roth IRA, but let's say you do it in a Roth IRA, right? Over a period of time, you just invest in that, put an S&P 500 index fund, which has basically negligible fees every single year, so you're getting pretty much pure market. You're getting
sure.
12% tax-free growth. How does that compare against the other
Well,
real estate? Because it just seems like the other way is just a lot of work and a lot of risk and a lot of stress. And just dump it in there and just be done with it, you know?
yeah. Okay. So two things. One, if you're investing with your retirement account, you get the same tax benefits as if you're buying stocks in your retirement account, right? So the tax deference would not be any different with that situation. So we
Well, I'm
can,
talking about a Roth, which is tax-free gross.
Yeah. But
yeah,
you could use money from the
yeah,
Roth to buy the real estate
yeah, you
is what
can
he's
do
saying.
a,
Can you? Okay.
So instead of putting in the S&P 500, you decide to put it into real estate instead.
Oh, okay.
yep.
All right.
So there are
Then
ways to do
you're
that,
doing an apples to apples as far as
right?
the tax
But
basis
that
goes.
means the money's got to be in there, which I guess is fine in both cases. Yeah, that's equal for
Yeah.
both cases, right? Yeah, okay.
Yeah.
Right. And I will say, so with real estate, a lot of people compare to the stock market. When they do that, they're comparing just your cash on cash return with what you get in the stock market. Where cash on cash is like hey, I put 100,000 in the deal and I'm getting this much back every month. What's the annual return on that money?
Yeah. Well, how else would you
Right?
compare it, right? Because if you do it the other
Asset
way, now
value.
you have a lot more risk, right? That
But
you're
the
not
asset value
controlling.
goes up too, right? I mean,
What's
when you're
that?
Yeah.
buying
So
stocks, that's an asset. The asset goes up in value. So you're not just
Yeah.
getting, it's more like a dividend stock, right? Because the dividend stock gives you
yeah, the
money
cash
and
on
it goes
cash.
up in value.
Yeah, in
Yeah.
my opinion, so the cash on cash really is like a dividend, like you said.
Yeah.
So, and and for me, I won't go into a property that's less than 8% cash on cash. Just I won't, and that's bare minimum. And
Wait,
I've gotten
it,
some that's
what does 8% mean?
pretty,
So if it were $100,000 property, what it would be an 8% cash on cash? What is that? What
um,
would that be? 8 grand?
that would be 8 grand a year. So that'd be
Yeah. Okay. So
667 a
basically, you're
month.
saying if I spend $100,000 on this property, I'm making 8,000 a year on rents. Is what is it's a simplified
Yeah,
view.
yes.
Okay.
After everything,
But-
after
Well, after.
property management, taxes, insurance,
Oh, okay.
repairs,
All right. So
capital
the rent may
expenditures.
be $12,000 a year, but you're making $8,000 a year after.
Yeah.
Okay, got it. Okay, I see.
Okay.
Yeah.
Okay. Can we break this down? This is interesting. So then,
Yeah.
let's say year one, you get $8,000 back. You put $100,000 in, and your underlying asset is going up. So you gotta count what your underlying asset is the value as well too, right?
So let's say it goes up
Yeah.
10%, so it goes to $110,000.
Well, here's something though, and when you're doing this, so I know you mentioned the risk of leverage, but here's the benefit of leverage.
Yeah.
Okay. All right. In Wisconsin, you don't get a huge appreciation. At the low end, 2%. Right. It's pretty mean.
Yeah, but in this example, you can't have leveraged money in one example and non-leveraged in the other, because that's a different problem.
No,
I'm talking about.
That's what you have to talk about. That is a huge benefit of real estate that you don't get with stock.
No, absolutely not. Right. So if I'm in the market, it's like I'm not using leveraged money. I mean, there's way more risk. So now you're in an asset with way more risk than one with not no risk, but less risk. You can't compare those together. I mean, that's a huge factor.
So let Chris finish his explanation, because I'm not understanding I understand what you're saying, Scott, but I'm not understanding his argument.
Okay.
All right.
Go ahead, Chris.
All I was going to say is, if you put 20% down, if you put 100% down in this property, you buy it in cash, no leverage, 2% appreciation, plus your 8% cash on cash return. Now you got 10% return. If you use leverage, you put 20% down, you get the same 2% appreciation. Now you're getting 10% on appreciation because you only put 20% into the deal.
Yeah, no, I get that, but that's irrelevant, right? Because you're not comparing apples and apples.
Not irrelevant.
But
not irrelevant because
completely irrelevant.
So Scott, you're talking about risk. All right, you're saying that the risk level is different because there's a loan of 80% on that property.
Correct.
Right?
And what they're saying is they only want to compare the end result and not taking the risk into effect.
So
huge difference.
I understand that, but there's already variances in the two scenarios here. So let's say one of them means you're holding a loan for $80K, right? Because you only paid 20% down, so you've got an $80K loan on one side, all right, that you're paying back. Now, Chris, when you're paying back, is that coming out of the 8%, or is that before the 8%? Is the 8% outright in your pocket income, or do you still have to pay the loan from that 8%?
No, that's after the mortgage payment, after everything.
So whatever you're pulling in from rent from the property, after you take out the mortgage, the property taxes, the property manager, all that stuff, you're getting 8% in your pocket in revenue.
But not in leverage money. I mean, if we're going to do it, we got to do apples and apples. We got to compare the same scenario.
So I'm walking through the scenario. It's the thought process in my head, right? So I'm walking through the scenario. All right. So you're making 8% off of $100,000 valued property. You've put in $20,000. You've got $80,000 in debt on that, right? So if something bad happened, then you would have to somehow cover the $80,000 debt potentially. I mean, what the something bad is, I don't know. The house burns up, whatever. You got insurance and all the other things in play. So I think, Scott, you're worried about the fact that there's this $80,000 debt, even though you're making money. I think what Chris is saying is, for a $20,000 investment, you're making $8,000 a year in income. Plus, you're getting the 2%, the $2,000 a year in
that
value.
sounds good, but that's not the question. That's not my question.
No,
that's answering a different question.
Okay,
I want to know the question of two people put in $100,000 equally at the same time.
Okay, so let's do that scenario. Let's just finish that scenario then. So you buy the property outright.
Let me take a step back. Okay, if you are a passive investor, you got $100,000. Okay, if you go buy $100,000 worth of stocks or say a REIT, if you really want to be apples to apples, we could do REITs, because that is really a real estate stock, basically.
Because asset class are the same in that case.
Right?
But I don't want to do that. I want to compare. I'm comparing the market against the real estate. That's what I want. That's my question.
Now, the companies you're buying, the stocks you're buying, do those companies have debt?
Do those companies have debt? I would assume some do, some don't. Yeah. Depends on,
they do.
Let's call the S&P 500. Let's do that, right?
A lot of them have debt. That's how they operate.
A lot of them debt, right?
So you're buying a fraction of a business, and that business is using debt to grow.
Fine.
Okay. If you invest in a real estate fund or a partnership situation like we're talking about where we're investing in real estate, you're not getting a loan, I'm getting a loan. You're investing in the company, the business that's buying the real estate with debt. You're not getting debt. My name's on the dotted line for the debt. You see what I'm saying?
So your argument is it's comparable to buying a stock in a company. I'm
Right.
just, in this case, it's a specific, it's you. You are the
No
company.
way. No way. No way. I don't buy that for a second. Come on, man. You're smarter than that. Come on. You know
No,
that's not true. I mean, that sounds good when you talk about it, but let's talk about reality.
no, but what would be the distinction? So, Scott, let's say it's not a real estate company. Let's say I want to invest in a cleaning supply company, right? And I want to
No,
do it
no,
through
no,
my,
no, no, no. That's not the question, Chris. Again, let's answer the question, right?
what is
The
your
question
question
is,
then? Because to me, this is the same thing.
let me rephrase the question. I got 100 grand. One
Yeah.
dude buys an S&P 500 index fund, plops it in, right? The other guy goes off and buys real estate. I want to know the difference in return
Okay.
on that for equal amounts of risk. I'm trying to determine performance of asset classes.
So Chris, but before we go into the differences and the values of what you're talking about, if you did that comparison, you bought $100,000 property or you bought 100,000 in S&P 500 stock, right? Let's walk through that scenario and then we can talk about the other things.
Yes.
Right? So you buy 100,000 in S&P 500 stock, you're going to get whatever the average return is on that stock, which
Let's
is
call it 12%, right?
okay, 12%. All right. So then now if we go over and look at buying a $100,000 property with an 8% return and a 2% growth, which it depends on the area you're in, right? 2% you said is on the low end. It could be, if you're depending
Right.
on where you are, it could be 3, 5, 10, some crazy places during the pandemic, 20, 30, 40% increase, right?
Yeah.
So
Yeah. So
what
it depends on
what
the
is the
area.
average
So
growth?
I was
What
just gonna
is
say like 8%, 8 to 12% would be Midwest.
okay?
And then so it's higher cash on cash, lower appreciation, which 2 is conservative, but average is 4 to 6% still. So just say 4 for appreciation. Okay. So 4
3 to
and
5% is what it says national average. Okay, so 4% makes sense.
there you go. So all right, so 4% appreciation, 8% cash on cash, which if you're going all in on cash, no debt, then that's equivalent to the cap rate. So you might hear that term as well.
Mhm.
So 8% cap rate, 4%. So you get 12%. So it's pretty much at that point a wash if you're going to go all in without using debt.
Okay,
And
but
without
you get a
using
lot more risk, though. Even that is way more riskier than investing in
Why?
500 companies, right?
Why?
Because my money is spread out across. I don't have one asset. I mean, it's spread out across 500 companies, right? So my risk is less. I don't have the same amount of what I would call company risk, right? That would be equivalent to investing in one company. I'm investing in 500 companies. So my risk automatically goes down because I'm more diversified.
Yeah. But
So there's still much higher risk in that scenario.
that's exactly why you use debt to buy properties
Which
because
increases your risk. But what I'm trying to do is what I want to do is I want to get
I don't know about that.
equal amounts of
Well,
risk. What's my return?
so
That's what I
Scott,
want.
there's a discrepancy between the two of your the conversation between the two of you in that Chris is saying that the debt is used to mitigate risk, and you're saying it increases risk. So I think we need to explore what the distinction here is in that.
Debt always increases risk. Always. I'm not saying it doesn't necessarily change my return, but it always increases risk.
I will
Because
say it changes risk. I don't know that it increases risk.
I say every single time, zero exceptions to
I
that.
understand where you're coming from. I'm not sure I agree with it though.
Oh,
So
very
Chris,
good. Okay.
Chris,
Okay.
can you make
I love it. So
your
we get to argue then.
can you make your argument as to how debt mitigates the risk?
Okay, well, and I think I alluded to this earlier. If you have an LLC, so the
Mhm.
LLC is one way you protect yourself from liabilities. Insurance is another way, liability insurance. And then just following the law and doing good practices with that.
Okay.
However, there's always going to be that tenant you can never prevent certain tenants from slipping and falling at their own accord,
Mm-hmm.
but it happened on your property. So now
Yep.
you're liable. And say the insurance won't cover it, say they pierce the corporate veil for whatever reason, and because you're in California and your LLC failed you, and you followed the law, but it doesn't matter because it's California, and so now you're in court against this person. And hey, here's the good thing is if you have debt on the property, number one, you look way less attractive to that attorney to even go after you in the first place. Because if you own 100% of that property, say it's $1 million property, California, like that's pretty realistic, $1 million property, they're thinking, wow, we
You
can
got
go
$1 million
after this
bucks.
dude for that $1 million property.
Yeah, right.
Right? If you have $800,000 of debt on that property, now you're only worth $200,000 to that lawyer.
Yeah.
They might not even pursue the case, especially if you have the right setup with your LLCs and they can't see all the other properties that you own and they're all in different entities. Now it just becomes a headache and
Okay.
not worth your time.
So
that's
I need to start. I need to write down the pros and cons here because I can immediately hear Scott's con on this one. But okay.
Sure. Yeah.
No, I'm fine with that. That's not even taken into the underlying. I guess it is because now you're talking about liability risk, which is part of your return. So that's fair actually. Yeah.
Okay.
Okay. And then the other way I would say, I don't know if it mitigates risk, but this compensates you for the risk, okay, is what we were talking about earlier. The appreciation now, if you have 20% down instead of 100% down, your return on the appreciation, the increase in equity, is now 5 times what it would have been before. So if you're in California and you're seeing 10% appreciation in a year, now you're getting 50% on your money, which you'll
Well,
never.
yeah, but that's not the same scenario, right? So
Wait, no.
Well,
He's
no,
saying the amount of money in and the amount of money you're making. You're starting with 1/5 the amount of money in, but you're making the same amount of money, and therefore for
well,
a 20.
let's say
Right.
this: you still put 100,000 in, right? Right. Let's say it's a
yeah.
$500,000 property. You put $100,000 in, where before so now you're able to buy a $500,000 property,
Oh,
and
so
that
you want to use
property.
leverage? Okay, but my still question is without using leverage, right?
Yeah, but then Chris's question was,
No.
what
We're
are the
making the
pros and
argument
cons of leverage?
why loans why taking out debt is actually a risk mitigation factor here, and that's the argument he's
But
making.
that's still not my question, though. We still haven't got to my question yet. We still want to go to debt. My
No, we
question is,
answered your question. Your question was answered.
Right.
well,
Your
what's
question
the
was
answer to my
answered.
question?
100,000 in a property or 100,000 in an S&P 500. It was a wash. It was a break even. And
No.
your argument on that was that being in one property was riskier because it was a single investment versus being in the S&P 500 because that was a diversified investment. And so he's now making the argument that loans actually help to diversify the risk.
Oh, I didn't even know we moved past that one. I don't think that's a good answer, actually. I think you guys just did some wazzle
Well,
dazzle and
no, I
just
mean
moved.
the whole thing was you were saying that you thought it was a risk because all your eggs were in one basket, basically. Which I said I get that point, but I don't necessarily
Okay.
think that. I think that the argument here is that taking on debt is, in Chris's argument, is a way to mitigate risk, and that's what he's making the case for right now.
Oh, okay. Fair enough. Okay, keep going.
Okay. All right. So yeah, the second point was just that if you do use debt, you can essentially buy more property or more property, more asset value, and so the return on your money, since you're only paying say 20% of the purchase price, 1/5, then the appreciation gives you 5 times, the return on your money compared to if you put all of your money in the deal.
So let me
So again, in
let me
California, if
okay.
you're
Go ahead.
getting 10% appreciation, that's a 50% return on your money, plus whatever the cap rate is out here, which I know it's lower. I don't know, 6% maybe. So then that's why out here it's all about appreciation, right?
Well, can I
Whereas
ask a
out,
question, Chris? I mean,
yeah,
Let's stay in the market you were talking about. Let's stay in Wisconsin where we were talking earlier, right? So you
Okay,
were
sure.
saying, we were saying 4% is the average across America for the appreciation of the value of the home. So if you're putting down 20%, you're taking a loan of 80%, right? Okay. So you put in the same 100K we were talking about earlier. You're now
Yeah.
taking out $500,000 in debt, a loan, or $400,000 in debt on top of whatever.
Yeah.
But now you buy $500,000 properties as opposed to $100,000 property.
Yep.
So the same dollar amount out of your pocket goes in, but now you have a debt of $400,000, right?
Hmm.
All right. However, you now have five properties, which is now beginning to address the idea that you're not all your eggs aren't in one basket, right? You could have those properties spread out in various places, which would help against natural disaster risk. You could there's a variety of things here that by just having more properties, you're to some extent diversifying the risk that he was talking about. So we're
Yeah,
beginning to
yeah,
address that
yeah.
aspect, right? So what you're doing is you're taking on $400,000 in debt to get that. So the question, I think, part of it is the fear of what that debt means as well, right? You know,
Right.
you
And
made the
now, if
argument that
you
it
have,
lowers the attraction for you as a someone to be sued because you're on paper your value is less, right?
yeah, and
So
now
what
here's another thing to look at too is, especially, okay, if your debt is through a commercial lender, it's not, you're not, because when you get into buying properties as an investment, you can only do about 10 conventional loans, like a Fannie Mae, Freddie Mac.
Right.
You can
Mhm.
only do about 10 of those. And those are always in your personal name, which you don't want anyways. So
Right.
generally, you want to move to what they call a DSCR loan, debt service coverage ratio. Basically, what this means is they will lend you money based on the performance of the property. So in addition to, so here's another advantage, okay? In addition to you analyzing the property, and obviously you're going to be biased because you
Of
want to
course.
buy more properties and you want to make more money. The bank is going to look at this in an unbiased way with all of their decades of experience and say, hey, because they don't want the loan to default. They're going to look at it and they're going to analyze the property as well and underwrite the property, not based on your income at all. They're going to 100% base it on, they'll look at your credit score, but they're going to mostly base it on the performance of the property. What's
Yeah.
the market rent in the area? They're going to take a fraction of that. What's the past performance of that property? Do you have professional management or are you managing it? If you're managing it, what's your experience? Is there any work to be done? Rehab work. They're going to get an appraisal. They're going to do all that stuff. If you buy it in cash, are you going to get an appraisal? That's your decision. A lot of investors probably won't. They're just going to buy it in cash. But the bank will require the appraisal. So they're putting all these things in place because they need to protect their risk,
Of course. Right. Right.
right? So that's another way to objectively look at the deal through another person's viewpoint because to them it's an investment as well. They're getting a return on their money, just as you're looking to get.
Well, and
Um,
their risk is going to be reflected in their interest rate they charge you.
right, right. But with that interest rate, it has to pass their DSCR requirements, meaning
Gotcha.
the
Yeah.
income it's taking in has to, and generally it's about 1.2, but it depends on the lender for the DSCR number, which means you're getting at least 20% more income than all of your expenses.
Hmm.
So you're getting a 20% coverage of your debt service. Um, and so that's how they mitigate their risk, which in turn is helping you to mitigate your risk a little
Right.
more objectively. And the other way, again, this is why real estate is serious, because if you only go in with one strategy, and I know this from experience, okay, you can lose money. You can lose a lot of money.
Yeah.
So you want to have at least three exit strategies. So if your first plan fails, you can go to plan B. And if that plan fails, you can go to plan C. And you need to make sure that maybe plan C is losing a little bit of money and that's worth your risk. But that depends on the investor and their
Well,
risk
yeah.
tolerance, right?
Better to use a
So
little bit than a lot, right?
yeah, it's the same with, like, some people with stocks, they'll go in and do options trading or they'll do day trading or all that stuff too. Obviously, there's a lot more risk with that than
Because it's
just,
leveraged money. maybe not the day trading, but certainly the options are definitely leveraged money.
It's speculative, it's short term,
Yeah.
it's speculative. You're assuming what's going to happen in the future.
Yeah, so this is really good too. What time horizon? Because that's a critical thing to talk about,
Yeah,
right?
and it really depends on the strategy. For me, when looking at using partners' money, and again, I'm just getting into this part of it
Yeah.
as I scale. But generally, talking with other investors, 5 to 10 years, when you're looking at long-term rental properties, especially big apartment complexes. I mean, if you're
Yeah.
getting in the hundreds of units, it's going to be closer to 10 years. Ideally, for me, I like 5 years because I don't want to be tied up in that partnership either for too long. I want to be able to buy out the partner, and
Yeah.
you know, depending on the individual, they might not want to be tied up for too long either. But I guess it depends on them, and if it's in their retirement account just sitting there anyways. Um, so
So how do you compare that strategy against a REIT?
yeah, so a REIT. Okay, so are we talking about buying this still in your retirement account or?
It doesn't really matter at this point. It doesn't matter as long as they're the same thing. As long as both are done in the retirement, both are done outside. I don't care. I
Yeah,
just need the apples to apples comparison because otherwise you can't
sure.
evaluate.
Yeah, sure. Okay.
And can we bring
Um,
up a point too, Chris? Maybe we could talk about this some. Is that when you're evaluating something, you've got to make sure all the constraints are the same applied to both of them. What I hear all the time, and this is probably why I get so like riled up actually, is people are not using the same constraints equally on
yeah,
different assets. And that's a huge
for sure.
logical thinking error.
For
Chris, a
sure.
big thing for us is we think constraints are what define your ability to think something through,
Okay.
right? Because if you haven't thought through and figured out what your constraints are, then you really don't know what the problem you're solving is or what the issue you're talking about is.
Okay.
Yeah, and you
Okay.
can really dilute yourself and kid yourself and do all sorts of,
Yeah, you can
stuff.
sell yourself anything, right? Sell
Yeah.
yourself into or out of any idea or concept, right? Um, okay, so with REITs, the big difference in my mind, um, and this is why I asked about the retirement plan and why it
I,
does matter because,
Actually, can you tell everyone, since I don't know if the audience knows what a REIT is, what is a REIT?
okay, a REIT is a real estate investment trust. That's the acronym that it stands for. It's very similar to, you can buy it on the open market, the stock market, just like you can buy a stock. So it's a liquid, it's a liquid investment where you can buy it one day and sell it the next day, just like you can with the stock. And the underlying asset is a company who owns a portfolio of real estate. So there's REITs that buy residential properties, there's REITs that buy commercial property, and everything in between. So you can, put a little bit in diversify in all these different asset classes within real estate that way. And I own some REITs in my
And it's important
IRA.
you mentioned it. It's a totally passive investment. You're not going to get a
Yeah,
phone call at 2 a.m. saying, "Oh, my plumbing's broken. Come fix it." Right?
that's very true. Yes,
Okay.
yes. The other thing, I believe that they are required, if they register as a REIT, that company, then they are required by the government to pass on 90, I believe it's 90% of their income to their investors.
Okay.
So that's just the structure, and if it makes sense for that company to classify
Right.
themselves as a
Right.
REIT. Um, okay, so the one distinguishing factor that I'm aware of between the two is that if you own real estate on your own, not a REIT, if you own real estate on your own, you get all of the tax deductions that come with that. That's why I was asking about the retirement account, because if it's in a Roth, it's you're not paying taxes on that ever
Right.
anyways. So then a REIT might make more sense if it's in a
But
Roth
it's
IRA.
harder to do that because if you have a Roth, I mean, assuming because you only put in what 7 or 8 thousand bucks a year, depending on your age. So it's not like you can just go take 100 grand and just dump it into that like day one.
Right,
So
right.
I'd rather use probably the non-Roth example or
Sure.
non-retirement something because then it's still not apples and apples. I want the same thing. I got 100 grand in the bank, and what can I do with this?
Okay, yeah. So if it's just purely in the bank, that would be the big difference. Because if you're buying a property yourself, then you get that tax benefit of depreciation.
Yeah.
And
Okay.
depending on your strategy, so if it's a commercial REIT and a commercial property, right? With commercial properties, a lot of investors will do what they call um, uh, a cost segregation study, which
Hmm.
is basically they're front loading a lot of that depreciation. So instead of just saying, so the IRS will let you depreciate a property over, if it's residential, it's 27 and a half years straight line. So they just take the value, divide it evenly, and you get the same write-off every single year. But if you do a cost segregation study, you'll break that asset into several pieces and say, hey, the roof's 10 years old. It's got another 10 years. So I'm going to depreciate it over 10 years, not
Yeah.
27 and a half. So
Yeah.
anyways, you do that, you get a lot of that benefit up front. And then after you've kind of stripped out all of that benefit, then you can sell that property. You can do a tax deferred exchange, a 1031 exchange,
Yeah. Like kind of
defer all
exchange.
that taxes, throw it onto the next property, and do it again.
Yeah. Exactly.
And so some people, that's their whole strategy, is the tax side,
Aren't you
right? And
getting,
so
which is a good strategy, but aren't you getting that tax inside the REIT as well? I mean, I know you're not. It's like a second order away from you, but it's still there, right? So is it possible to say that's an
well,
advantage doing it personally?
you're not getting any write-offs on it though. You are paying taxes on the income that you collect in the REIT.
Yeah,
So
but
if
that
you
isn't the income pulled off. I mean, the depreciation is pulled off your income, right? That you're getting in the REIT.
no, you don't say that again.
So the income you're getting, right? You're going to get way more income coming in if you own the property directly and you get the tax write-up. But if you're getting income through the REIT, that depreciation is taken off that income that you're getting to start with, right? The benefit of that. Or is that a difference?
So you're
Yeah, I
saying
think it's
the
a
money I
different.
get from my REIT investment, Scott, has already had that taken off? Is that what you're
Well,
saying?
I'm asking. I don't know. This is an honest question. I'm not trying to
I
lead
see.
anybody anywhere. I don't know. I'm assuming it would be, right? Because I mean, it's real
I
estate. So you're
believe though I think we should do more research on this. This is a good question, but I think that to my knowledge, I believe that they account for it differently, because if you look at like the balance sheets of a business and how they account for depreciation, they add that into the equity, and you're not getting paid on the equity by owning a REIT. You're getting paid just on the income from the rents, right? So
well, but I
I
am
don't know.
getting income from the REIT, right? But the
Mhm.
overall asset is increasing as well based upon the market value of those assets are increasing, right? And so then when I sell that stock, that's when I'm going to get dinged
True.
on my capital appreciation.
Yeah. But then the depreciation
The
depreciate.
depreciation is taking care of my income, right?
Yeah. I think we'll have to look more into it to get a firm answer on it.
Yeah, yeah, because I guess overall my question is, I love
Yeah.
the idea of real estate, but
Yeah.
is the juice worth the squeeze, man? Because it's a lot of work. There's
Yeah.
more risk doing it individually, and it's just a lot of stress, you know? I don't have
But
to,
Yeah.
last thing I want to
I
do
got
is flip tenants.
I got a question. So we know that the stock price, the price of a share of stock, isn't exactly based upon the value of the company, right? It's based upon the perceived value that people are willing to pay. So if a
Well,
stock is no, if a stock is popular, demand goes up, price goes up because people are paying more for it.
in
So
in the short term,
the
in the short
underlying,
term.
well, I'm just saying, in the underlying value of the company stock is not 100% tied to some calculation from what the company has on hand in the way of dollar value.
Well, here's
So
how it
I
works, Chris.
so wait, let me finish I haven't even gotten to my question yet. Okay,
Okay.
so now my question
Well, but
is,
Taki, I think your statement is not true,
if
actually.
you even don't know what I'm going to say, then you have no idea what to attack yet. So
Dude,
the
no,
idea here is
I know it's
that does that hold true for real estate stocks too? So when you buy a REIT, a share of a REIT, are you buying it based upon the value of the portfolio of property, or is there some other value on top of that? So here's the value of the property. They got $1 billion in property, and then we calculate the share value. Oh, but this particular REIT is in an area of the country that was really popular, so everyone's buying it, and therefore suddenly the demand is up, the share price goes up. Now is that true? And it was my question. And if so, then the do they recalculate the value of the property, and does that get in built back into the stock price over time? So in the next year, the property value doubled, let's say, so it's now $2 billion of property instead of $1 billion of property. Are they going to recalculate the stock price, or is it going to impact the stock price in some way because of that? That's my question.
Well, before we get to your question, let's attack the beginning part, actually. So, because you made a statement, and the statement is false, right? Before you even got to your question. So the price of a company is valued based on future earnings. That's what drives all stock prices, right? And then what happens is there's a ratio called the PE, price to earnings ratio, on that. And so, yeah, there's a ton of speculation and that sort of stuff in the short term. You can get emotion driven into that. But I'm trying to take that out of it, and because that's
Scott, you just gave the whole point to me. You said yes, emotion gets into that and drives price. So yes, it's affected. Doesn't matter if it's 1%, 10%. Doesn't matter if it's 1 day, 1 hour, 1 minute. You gave in my point. My point is the price is not directly something that I can calculate based upon some value structure that's out there. It can't be done. I can get guidance, but that's not the same thing as knowing the real value.
Hang on a second. Actually, you didn't put the constraint around it that said what period of time. That's what I'm getting you on. If you would have said that up front.
Because I had no period of time, then the period of time can be anything.
Okay, that's kind of weak if you want to. Okay, I mean, technically you win, but
you're the one who put the constraint of a period of time, and then you even didn't give me the period of time. So the idea here being you're not even defining a constraint. You're saying there's a constraint on time, but you're not even defining what it is. And I'm saying there's no constraint on time.
There's possibly you could be right a little bit. I'll give you a little bit, right? Not much. I'll give you a little bit of rope.
So Chris, we're trying to learn how to argue, by the way.
Wait a minute.
So let's define time. Let's define time, right? What time frame? Because that is an important part. That's a very important part. Are we talking Scott, 1 day, 1 second, 1 minute?
When you're talking about, go back to 1950s when you were buying a stock.
Okay.
Right? How did they calculate out a value of a
I wasn't alive in the 1950s, so I don't know.
So no, I think what goes into that calculation. So I think you're right. There's an expectation of earnings, right? There's an expectation of earnings. There's also historical earnings that go into that. And then there's what assets does the company own versus what debt do they own. All those calculations kind of go into how much is this company worth. It's worth $1 billion, but it has $900 million in debt, so it's only worth $100 million, right? So then you figure, okay, so I now want to sell shares because of this company. We use $100 million as one number. How much money has it made over the past 10 years? What is its average yearly? So what is our expectation next year? And how do we adjust the expectation of how much money it's going to make based upon what's going on in the market, what's going on in the government, all that kind of stuff, right? So then we say, oh, it's going to make this much money. And so now that influences the price. Now everyone sees you buying that. And so supply and demand now comes into play and says, oh, we're driving up the price, not because it's worth more on paper, but because suddenly there's a demand there. So there's all these different
just because I'm a nice guy, I'm going to evaluate your point right now. So let's look at yesterday. The market had a bad day yesterday, right?
Oh, yeah.
Like down 5% or something like that. So what that's saying is, does that mean that the value of every company is truly worth 5% less? And I'm saying no, that's not true, right?
I agree with that. The idea that the actual value of a company is irrelevant of the stock.
Well, let's not go there. Come on. Now you're taking it. I'll give you a little bit of that, but not the whole thing. Right?
It's certainly impacted by other measures or other means. I did want to just highlight one thing, and I'm sure you're aware of this anyways, because you're talking more about the S&P as a whole, but if you're talking individual REITs and then comparing that to individual stocks, and you want to talk about PE ratios, like Tesla has a PE ratio of 117, Costco has one of 53, and American Express has 16, right? So it's all over the map. So
when you're talking about a PE of 117, that's insane, right?
Yeah,
that's just...
you
beyond
know,
belief crazy. But there's a belief that Tesla is going to
right.
explode down the
Okay, so
road.
let's
There's
explain for the audience,
speculation.
because what is a PE
Speculation.
ratio? What does it mean?
Yeah, go ahead, Chris.
Sure. Okay, so it's the price to earnings ratio. So it's simply, the price of the stock over the EPS, the earnings per share of the company.
So if it's a
You know,
big number, what does that mean?
that
Bad.
means you're paying a lot
Yeah.
for, you're paying a lot for the earnings that they're
So
making.
if I pay $100 stock and I get $1 back, what is that as a price to earnings ratio?
100 to 1.
Okay, and then if I pay $100 stock but I get $50 back, what does that mean?
Well, you don't typically that'd be pretty awesome, but whatever. That's a 1 to 2, right?
Okay, it's a 2 to 1 or 1 to 2?
And also
It's the price over earnings, right? So if you paid 100 and
2
you
to
get
1.
50 back, yeah, one
Yeah.
half, 0.5.
also
So-
it's the earnings of the company, not the earnings to you, the shareholder,
Right.
which is
Yeah.
definitely not always correlated. So, it's different than a dividend. It is different than a
It's
dividend.
very different than a dividend. Yeah, dividend is what a company directly pays back to you, actually.
Mhm.
And you can buy different stocks. If you want dividend stocks, maybe buy different ones. If you want growth and technology stocks. Chris, let me tie this back into faith, right? Because we always come back to faith. It's basically you have faith that Tesla is going to excel moving forward. So I'm willing to stomach that, whatever you said, the 117 to 1 PE ratio.
So your earlier argument that is based on P over P&E is wrong then, because you said it was based on that. So it is totally in faith. It is totally in belief. It is totally in emotion. It's not based upon the real value of the company. It's based on the perceived value of the company.
I would call it
You're never making my argument for me.
in the short term, absolutely. Less in the long. I guess it depends on how long, right? Second to second, no doubt. Day to day, no doubt. Maybe 10 years out, it's less and less, right? I think so. Yeah, so there's no doubt it's a factor. And I think I think it's fair to say the shorter
This
term.
goes back to my question: how much of that impacts the REIT values versus like a stock value? Is it the same, or is it basically a stock?
yeah,
In which case, the portfolio is less important than the perceived value of that REIT.
And what time duration, though? More than 10 years? No. Tomorrow? Yes.
But it's
More than
it's
10
also
years, no.
depending on like this, what asset, what types of real estate, right? Because there are REITs that only buy. There's one REIT in particular that only buys land that's leased to marijuana companies, right? Companies that grow pot. So you're it's indirectly tied to that other market. So there's all sorts of other variables as well. So like in
So
that
we
instance,
need one that sells to power companies located next door to technology companies, because that's going to be AI driven.
Very light. I mean, that could, I have faith that's probably true, but it's definitely not guaranteed for sure.
So Chris, I met a guy at one of these mixers that I went to that actually he's raising money right now to build a power company in, I forgot what state it is, because there's another company that wants to build a tech company which focuses on AI right next door. They want to run the AI computers next door, so they need the power to do it. And so he's actually investing, raising money to build the power generator.
Yeah.
nice, cool. Awesome.
I mean, so this is why it's really interesting. The people who are really thinking about where to invest their money think about that kind of thing, right? It's like the obvious one is during the pandemic, we all should have been buying Zoom, Pfizer, and all these companies that went up. And had we spent, I didn't do any of that, but had I spent a little time thinking about that, that was a pretty obvious thing to do, right? Hindsight's 20/20, but I mean, this wouldn't have taken much foresight to figure out.
But
and
this
I think
is what we should have been talking, Chris, because this is what we do know, right? We know that on average, a pandemic is going to last about 2 years, right? That was just, I mean, I think everybody knows that, right? So
that is, the government was saying 3 months, 2 months, and I'm like, no, 2 years. But yeah, let's
if you go back through history,
stay-at-home orders. That was 2 years. I mean, come on.
Right. If you go through history, you see it's about 2 years, right? Maybe 2 to 3 actually. So we know it's like this. We know that there's going to be a pent-up demand for stuff to do at home for a couple of years, more than likely. So yeah, you should have bought Peloton. You should have bought some whatever, right? Stay-at-home stuff.
Well, but also realizing that people with the ability to work from home, that a huge amount of the workforce would have been working from home. And then by not having being tied to where your company is, so many people would move to places where they could afford more house.
Yeah, right.
That's another thing. Any industry associated with that was something we should have been looking at too. I mean,
Well, yeah, and let's go back to,
this is
yeah.
second and third order thinking, but it's not that hard to figure out.
No, let's go back to Zoom though, right? So
Yeah.
now we know it's obvious now that Zoom, but it's like, who knows? There could have been 7 other companies that popped up, and one
There were other companies out
Zoom,
there,
right?
right? Skype was out there. We also had Adobe had Adobe Connect,
Yeah,
and
right.
my company used Adobe Connect for years, and
Yeah,
that was an incredible one. The thing with Zoom that a lot of people didn't realize is they were on the phone with companies changing their software quickly to adapt to the needs of the company, which
yeah,
really made a huge impact. And so if you actually then looked at how the company reacted to their clientele, you would see Zoom was the one that was more responsive.
yeah. So maybe there's a little hint, but it was no way
So
guaranteed that Zoom would.
that's a third order consequence in a different direction.
So then they
Yes.
have that. Didn't they have like a data breach too, though? They had all the
They
security
had data,
issues for a
yeah,
while.
yeah.
So
I think data breach isn't the norm anymore. I've
yeah,
gotten 7 letters in the last 2 months about medical data breaches from
just
doctors I've
assume
been to.
all your information's out there. It's
It's all out there. Hey, so here's an interesting chart that I pulled up, right? Comparing S&P 500 to REITs, and I don't know which REIT it is. They just said all equity REITs. So it's interesting that in the long term, REITs outpaced S&P 500s. But certainly in the past 10 years, like the numbers there is 11.1% to 7.2, S&P 500 being 11. Past 5 years is 15 to 5, and in the past year, S&P 23 to 5%. So
So,
it's like,
yes, Scott, I
yeah.
think if you look at it though, this goes to your argument of over time, over a long period of time,
so
the
time
asset
matters a
value, the
lot.
asset values actually do have an impact on the
And
overall
and
return.
Oh
I don't
yeah.
know if you know. Do you know if that chart accounts for dividends? Because REITs generally pay a higher, distribution because they have to give you 90%.
That I
I'm assuming
don't
it does.
know.
I'm assuming it's the overall output, right? So it would be the value of that
Total
stock
return.
over time. Yeah. Well, those
Oh
dividends you're
yeah.
talking about, those dividends, is this for a retirement fund or for just a general, Scott, the one you're
This
looking
is
at?
just general. It's not in a return.
Okay.
So yeah, dividends drive much of REIT returns. Yeah, it is the little section I'm reading right now. So almost certainly, yeah.
Okay.
Oh, this is interesting. So dividend payments are meaningful contributors to investment returns for stocks and REITs. For example, since 1940, 34% of the S&P total return has come from dividends. And then what else? Then they wander around. I don't know.
Remember, stocks used to be you got a dividend because you were an owner of the company and you got money out of it. It wasn't
Yeah,
until later when we started selling all these different versions of stocks that don't give you anything but a piece of paper that, and
well,
not even that anymore.
that's when technology really came up, right? Because then technology is
Yep.
like, PEs
Give us
don't
money.
matter.
We want to build more stuff. Yeah.
Yeah, because we're going to change the world, right? We're the next Apple or
Yeah.
something.
Yeah.
Oh,
Hey,
about
Chris,
half of REITs returns
how
from
are you doing on
dividends.
time? I know you said you might have a hard stop.
Yeah, I do have to jump. Probably about another 5 minutes.
Okay,
Okay.
this is interesting. Okay, so then what are your recommendations, Chris? I mean, and for who is it for?
So here's what I see. So okay, there's two perspectives in my mind with the real estate, right? There's passive and active. Obviously, I'm doing active. Um, the reason I'm doing active is because I I want. So I created a company called the Flow Authority,
Hmm.
and it's all about helping people become the authority of their flow, meaning, taking control of their life, right?
Yeah.
Being in command of your life. And to me, real estate, it's just one vehicle. I mean, you can do this with any business, but I see the path clearly with real estate. And when you get the portfolio built out and you have the property managers and you have your teams in place, it can be very, very passive. You're still going to
Yeah.
spend some time on it, but compared to working 9 to 5, right, you're going to free up a lot of your time. And so,
Hmm.
really, what I'm looking for, I want the control of my life back. I don't want to work till I'm 65 and have to rely on, a 401k, or at least not just a 401k for my retirement. and I want something to pass down to my family. And so I'm looking at this as a vehicle for financial freedom, not just, long-term retirement.
Yeah.
It's bigger than that for me. So on the active side, you can do just about anything you can envision or imagine with this, because there's so many strategies that I believe there's something for everyone. And on the flip side, if you're someone who's like, I'm making plenty of money, I'm happy doing what I'm doing, I don't need all that, or you're content with where you're going in life, and the career sense, you just want to diversify a little bit, then that's where maybe the passive investment opportunity might be better for you. If you have time and no money, active investing is great. If you have money and no time, passive investing is great.
Yeah.
So that's kind of my feel, and I can help with either of those avenues.
Yeah, that seems to be the general trend of things. The Going to the name, you mentioned it earlier, Robert Kiyosaki, is that you work, you get some cash, and instead of spending that money on TVs and stupid stuff, you put it into an asset that kicks off cash. That sort of seems to be the general, and whatever that asset is I would recommend whatever that asset is, you better understand it pretty well, because the better you understand it, the better chance you're gonna not get messed up, right? You're not going to lose money, because I know for me, the number one rule of investing is don't lose money. Losing money is bad.
Yes, absolutely. And to your point, this is why I joined the group that I'm a part of, because we have over 90 classes. And when I say class, it's, about 6 hours on average. So it's a lot. I don't know anybody who's gotten through all of it, because
Yeah.
you kind of pick your lane and go that direction. But if you want to learn, and then we re-record classes as strategies change, as the tax code changes, as the laws change, as new strategies emerge, we add classes at no additional cost as well. And so it's a great group to be with, to get the knowledge and reduce your risk that way. The other huge thing, though, is the network of individuals.
Yeah.
In addition, we've got thousands of people in this program, and we meet every week. And so before I ever sign on a deal, I bring my deal to what we call our mastermind call every week. And I'll go over the numbers, I'll go over the strategy, I'll go over my multiple exits with the team and get their thoughts, make sure that I'm not missing anything. And I'm not purposely ignoring information because I just want to get into another deal, because it's really easy to do that when you're doing this on your own.
And man, you got to fight the emotion like crazy, because it's just.
With stocks, I really struggle with the emotions, man.
Yeah.
So, real estate, it's you can do the same thing. Like you said, you can sell yourself into or out of any deal, idea, purchase, whatever, right? You're the best and worst salesman in the world to yourself. And so having objective people around you that have your best interest at heart is...
Yeah, I know for me personally, I'm a reasonably good investor, and I got a degree in finance. So I understand the basics. But, the Bitcoin thing, I got caught up in the emotion of it. And that was like a $30,000 lesson, a little lesson. Don't do that, right?
So, but Scott, I mean, is it down from where you bought it now?
No, I've lost $30,000 actually.
When did you buy?
Way back when, and then I sold it, and yeah.
Oh, you sold it? Yeah, I mean, had you held it though, what would it be worth?
I would probably have made a lot more money actually. It was at 80.
My
risk tolerance is just too volatile for me. It's too much.
Yeah. No. Yeah. So one of our guests we had a couple weeks ago, a buddy of mine, he puts a lot of his money in specifically Bitcoin. So, and I think the volatility bothers me, right? And he doesn't see the volatility as problematic so much, because he's looking at it in a much longer time frame, and he has a lot of faith in the underlying blockchain that underneath it.
Yeah, always comes back to faith, doesn't it? Somehow it always comes back to faith.
I'll tell you what I have faith in, though. I have faith that there's a need for tenants. There's a need for housing.
Oh, no question. Yeah.
And I don't think that's going away anytime soon. So
No, but
in that
BlackRock will
regard,
buy up all of it, and then they'll make a contract with the government, and the government will pay them money, and none of us will have to own anything, and then we can just all be subservient to the government. I mean, that's the
but
path,
hey,
right?
there's I like to think, I
You
always
know,
try to think with an abundance mentality, not a what's the opposite of abundance?
You're too positive. No. Scott, what were you saying, Scott?
yeah, and my thought is, I tend to be more of a negative thinker. I come from the belief that it can always get worse. So I'm always right. What's my
Sure.
downside? How can I get hurt? What can happen? And
All right. Keep your, what is it? Keep your hopes up high and your head down low, right?
yeah, I think so, right? I think, and I really like the idea of running it by other smart people. This is like a biblical concept. It says always seek wise counsel on everything you do, because man, emotion, your emotions can just get away from you, and you
Yeah.
start to make bad decisions.
Yeah, absolutely.
So, all right. So Chris, why don't you give us a link? We'll put it down in the show notes below. Like if somebody wants to reach you or learn more about what you do, give us a link, and we'll put it in there. And you can say it out loud now, and then maybe send it to Chris, and I'll put it in the show notes when we get to put this video online.
Oh, sure. Yeah. I usually will go off my Linktree account. So let me just confirm. So it's Linktree, it's the Flow Authority. So Linktree / the Flow Authority.
Okay, we'll put that in the notes. That's awesome.
You're also on YouTube, aren't you?
Yeah, and I've got all the Linktree has everything on there, so you can find my YouTube channel and Facebook,
Okay.
Instagram, TikTok. I'm trying to be everywhere all at once. Omnipresence. It's harder than it sounds.
It's very hard to do.
Very hard to do.
Especially with a W-2. But hey, I'm doing all I can here, right? So
This is interesting. Hey, one thing before we go, I just want to bring up something I forgot from school, but it's called beta. And beta is a measure of volatility / risk. And it's interesting here because they found, and they're not saying what the time period is, but REITs had a beta of 0.94, where the S&P had a beta of 1.17, which means dividend growth had lower risk in REITs than the S&P 500 over the long term. That's interesting. And so I think one thing that I'd really like people to think about is think about not just the return, but think about the risk on that return, particularly something called the beta. I think would be just another way to think through things.
So is that industry, you think? Some industries have a higher risk than others? Because real estate in general, we tend to assume is going to go up in value, right? And I think there's a lot of faith, back to faith and belief, that the idea that, real estate values go up.
So I think over the long term, absolutely.
No matter what's going on with the economy, you can kind of rely on the value of real estate to be increasing over time. Is kind of the.
Well, and I like the idea because people need a place to live, right? There's no question about that.
But a lot of these big companies, these big blue chip stocks from the 50s, don't exist anymore, or General Electric is not what it was in the 1950s and 60s.
Yeah, right.
So you end up with. We don't know. We no longer believe that these stocks will continually go up forever. We know that the next company can come along at any point, but
especially in technology,
a piece of property doesn't disappear. Usually, it's still there in 50 years.
Usually, yeah, that's exactly right. Yeah, we ought to talk more about beta. I think that's just such an important thing, because I guess my pet peeve is that people they look at just the returns, but they don't think of the different levels of risk.
Do you have that rating for Bitcoin?
I don't know. Let me tell you something. I got sucked in because I watched a bunch of YouTube videos, and this one guy was talking about how great Bitcoin was, and it's a store of value, and it's this, and it's all that, or whatever like that. And I'm thinking to myself, yeah, but when I look at how it performs against the market, it performs more like a tech stock as opposed to gold, right? Which is technically, it's supposed to be closer to gold. And that just threw me off, And I've got to tell you, the day I sold it before Trump won, let me phrase it. The day after I sold it, it shot up like 30% or something. Because as soon as Trump won, bam, it just shot up like crazy to over 100 grand. So
I recently bought a little bit of Bitcoin because I don't know. My friend's been preaching to me about this.
Yeah.
He's like, Bitcoin and Tesla, Bitcoin and Tesla. I'm like, all right. And I listened to um, some talks from Ray Dalio and
Oh yeah.
um,
Yep.
big hedge fund guy, and he's had negative things to say, but even him, he's kind of caving and buying a little bit of it. So I'm like, all right, if Ray's buying this, I'm like, I'll buy a little bit. I'll buy a little bit of that.
Yeah.
He also said though,
Well,
he also said have more gold than Bitcoin. So I'm like, I did that. So I bought a
Yeah.
little more gold, a little less Bitcoin.
well, if
But it was
Berkshire Hathaway starts buying Bitcoin,
Yeah. Yeah.
yeah,
Yeah. Yeah.
we're
He was
then
definitely
we know.
saying, yeah, this is the stupidest thing you can do.
or was it Dave Ramsey? I think those are the other guy we need to watch. The naysayers,
Yeah,
if they start really,
there.
um,
Yeah.
I guess at one point it'll be how much fear do you have of government-backed digital currencies versus Bitcoin, right? Because government-backed means government control, and it's always going to be one of the fears. The thing with physical cash dollars is government can make all kinds of rules about it, but whoever has the physical dollar has the value in hand, right? Or has the ability to spend it in hand.
Theoretically,
With,
no. Well,
with,
maybe
with,
not if it's a
with,
REIT. Sorry, not a
no,
REIT. Not if it's a, what do you call it? The one that's not backed by anything. A
the,
fiat currency.
fiat currency. No, but fiat currency still has whatever the perceived value is at the time is something in your hand. The problem with digital currency is the government on the back end can strip out the value of it. Even because you've got nothing in your hand. It's a digital. It's online.
Well, I think, Chris, I think we can agree on this, you and I, is that the government wants to increase control. It's like they never want to give up control.
Yes, but
So we
also
can
over the
probably,
past 50 years, the government wants us to go into debt to spend because that drives economic growth. It
yeah,
drives
right.
the movement of dollars, right?
Yeah,
Every time a dollar passes hands, the economy gets bigger,
yeah.
right? And so they don't want us to save. They don't want us to invest as a whole, except for the people who have the money to begin with, right?
Yeah.
Hey guys, I got to hop.
All right,
All right,
Chris.
Chris, thanks
We'll
a
see
lot.
you.
It's been great. Yeah, thanks for having me on. Appreciate it.
Okay.
All right.